Good day, traders and investors. My name is Roger Scott, and I'm the senior strategist of WealthPress, or for WealthPress. Today is Wednesday. It's February 2nd, 2022. Don't ask me where the year has gone. And by the way, folks, if I've been helping you stay out of trouble during this pullback, it's been the worst pullback we've had since COVID, let me know. Send me an email. I love hearing emails from you. I love getting them. They get me up in the morning and get me working on these videos. Support at marketgeeks.com. That's support at marketgeeks.com. I'd love to hear from you, and if you have any ideas or if you want me to cover something in depth, let me know. Now, let's get into today's video. So, as you can see here, the NASDAQ is up big, and I mean up big. Why? Earnings. Google earnings came out better than expected. Earnings on tech are coming better than expected. Who would have thought that would happen? Gee, let me think for a while. I told you that there's a really good chance we may get a tech rally if the numbers are good. Microsoft numbers were good. Apple numbers were good. I think AMD numbers were really good. And by the way, you know what GM said the other day when they reported earnings? That the chip shortage is not as bad as they expected at this point. Exactly what I've been telling all of you guys for the last several months. So let's get into today's analysis. But that's why the market's big. Google had really, really good numbers. And we'll talk about that in a bit. But look at the chart. The S&P 500 is way above the 200-day moving average. If we can break above the 50-day moving average, that's going to give us a green light to be bullish again. That's the S&P 500. QQQ, same thing. We gapped up. I think we may cool off a little bit, but we gapped up. And it looks like we're going to go and try to hit the 50-day moving average. This gap is massive. Look at this. We didn't even fill the gap in the morning. We're already up 6.4% or 1.75%, 6.34 points on the QQQ. I apologize. I'm getting carried away with these numbers. And the Dow, well, let me tell you, folks, we're just a hair from that 35,500 or 355 if you're looking at the DIA ETF, which tracks exactly the same thing. It's just missing a zero. So again, if we can break through this 50-day moving average, we are going to be in a much, much, much better position than we are right now, or that we were all the way down here. Remember this? I told you guys, as long as we continue making higher highs and higher lows, the markets will look stable, and they are stabilizing. And I love, love, love the fact that we're right below the 50-day line. If this thing pops, and I think it will with today's numbers, we could be looking at a nice big fat rally. All right, volatility levels, they're coming off. Volatility is almost back to normal. And we did a credit spread here for one of our programs as a bonus. That credit spread is working out really well. Again, nice juicy pullback, and if volatility continues moving lower, markets will continue stabilizing. As you can see here, typically these bumps, these volatility bumps, they don't last long. And again, we're almost at the base right here, just almost there. There's just not much more to go. Put the call ratio, we closed yesterday above 1, which is still telling us that the market has more downside to go. And we haven't really broke above the first upper end of the range, which still tells us the market has a lot more bullish behavior within its purview or control, if you will. But once we drop to the 80, 70 level, that means market participants are becoming a little bit too bullish. But at this point, they're still kind of bearish and holding off and thinking and hoping that the market's going to get better. And that's where we're at right now. So we still have a lot of traders on the sideline, which can give us some of the best bullish opportunities. Because remember, this put to call ratio is a fading indicator. And boy, oh boy, this was definitely a fading indication. Looking at the sector analysis over the last 5 days, look at this. Information technology, communication services, consumer discretionaries back here. Now, if you look at my stock fetcher code, which we will look at in a second, you will see that consumer discretionary on a cumulative basis is all the way down here, and technology is all the way up here. I'm expecting these two to come together as they are on a monthly. This is a monthly basis. Look at monthly. You've got technology here and consumer discretionary here, but I think consumer discretionary is going to start rising actually. And off of the cumulative basis and the monthly basis, consumer discretionary will start joining technology and start moving higher. Meanwhile, we're still defensive, very, very, very defensive. And again, Last 5 days, information technology, communication, energy still up there, but look at consumer discretionary. Aside from energy, this is very, very speculative. Now, on a 1 month basis, it's still very defensive. We still haven't seen that much luck. And yesterday, it says today, but this is yesterday, we saw some basic materials, financial, and industrials move higher. But I'm really happy to see that over a 5-day period, consumer discretionary is all the way up here. This is really positive, and it's showing us that earnings are having a massive, massive, massive control over this market right now. Now, in terms of today's meetings, yesterday we had construction spending, we had JOLTS. Most of the reports are looking solid. They're not looking too bad, but I'll be very straight with you. Earnings and Fed are overshadowing most of this data right now. Today we have an OPEC meeting. Energies are looking really good. Tomorrow we have jobless claims and productivity, followed by employment situation. This is the big report for the week. Let's talk a little bit about global economy, and then we'll move into the hottest long stock and the hottest short stock to get you guys going on this bull run. So U.S. stocks are coming off their worst month since early pandemic nearly 2 years ago. Investors are still trying to figure out how the economy and corporate profits will be affected by the upcoming Federal Reserve hikes intended to cool inflation that has surged to a 4-decade high. S&P is now only within 5% of its January 3rd high. That's when it made all-time highs, January 3rd. A little bit less than a month ago. Today's the 2nd of February, so just a shy of a month ago. Fed officials said in mid-December, and this is what really caused the market to start, tanking, that the plans to wind down bond purchases and other stimulus that are boosting prices would be accelerated to cool inflation, which is desperately needed a year ago. Consumers have kept spending despite higher prices, but forecasters worry retail purchases might weaken, crimping economic growth. So far, we have not seen this on this earnings. I'm going to tell you, the earnings have been really good. Later today, I'm going to do an earnings update, actually. Investors expect the Fed to hike rates at least 4 times this year, starting in March. I'd be surprised if we went over 2 times this year, based on what I'm seeing right now. But what do I know? Looking at the bond market, and we definitely want to look at the bond market right now because the bond dictates the stock price movement. As you can see here, we're in this range right now. And I actually think we're going to break out of this range to the upside, go up to about the 150 level and cool off. But I think we're going to be in a wait and see pattern for quite some time. And if that's the case, then the markets will become rather choppy because the stock market gets its directional bias from the bond market. And in my opinion, this is way, way, way too much too soon. But for now, expect some choppiness and non-direction, which is very common after having a big, big trending move like that. Now, today's Wednesday, and on Wednesday, I give you guys my top stock and my bottom stock. So my top stock right now is Comerica. We recommended the stock right here on October the 6th when it was priced around $83. Now it's at $95. It went up to as high as $101. It's pulling back. I like this stock right now. I think financials are going to do well in light of strong retail sales. And I think the stock is going to test new highs. Interest rates are not going higher. They're not going lower, but they're not going higher, which is pretty good for bank stocks. And bank stocks did pretty good this earnings season. So I think this stock is going to continue moving higher, and there's more upside potential here. So that's my stock, Comerica. And let me give you an option for that. Let's see, we would go up to about 71 days, and we'd go to about the 97.50 strike price. Perfect, right here. Look at that. It's in the high 3, low 4s in that ballpark. Yeah, you don't need to go all the way to 95 unless you really, really want to. And if you're doing a spread, you would do a 95 against the 105. That's a good spread right there. 95 versus the 105. If you're doing the individual, you could just do the 97.50. Offset some costs there, but your delta would be a little less. Your sensitivity to the underlying will be a little less. But I do like this stock. And for the downside, this one, IPG Photonics, this is just, look at this thing. Made an all-time high last year, has been just going down, down, down. And if you sold every rally, you'd probably do really good. Look at this. Sold off, sold off. Every rally is a downside. If you look at the profile of the stock, you will see it's a laser technology, laser semiconductor, laser fiber optic laser for use in diverse applications, materials processing. I haven't seen anything positive from this company in a while. In 5 years, they grew 30%. 5-year earnings growth is negative 15%. 1-year growth is negative 34%. Let's see if there's any option liquidity on this sucker. We want to go out same time period. Let's go to puts here. This price is 151. You can go to right here. It's kind of expensive, actually. Probably better off going to this one here that has a little bit more open interest right there. But honestly, liquidity is just not that great. If anything, you do the 140, 145. You could probably work a better deal on this, but I'm not seeing any major liquidity at all. So you got to be careful on this one, IPGP. But I like the market. I think we're going to go higher. I think we're going to start getting a little more volatility. But I like what we're seeing right now. Earnings is driving the market. And if Fed data tomorrow and Friday is on par, and if factory orders are good, we could see some more upside. So right now, higher markets, stronger growth, more volatility, and starting to see tech and consumer discretionary go a bit higher. Now, before I let you go, I've got something really important, timely, something you need to pay attention to. With so many factors affecting the stock market, it's been harder to spot good risk to reward versus opportunities because of the volatility. It's been going just nuts. And that's why I've recorded a special training session that will outline three critical components of profitable pullback trading. You got to check this out. It's very cool. It's very specific. All meat and potatoes, no fluff. Viewers will discover how to identify high probability, low risk entry opportunities, how to identify and measure the strength of the main trend, and much, much more. Folks, there's never ever been a better time to add more options to your trading toolkit than right now. Markets are passing the 50-day moving average. I like what we're seeing. I think markets are going to be strong. There's obviously going to be some hiccups, but we're coming out of this correction in a very firm way. Follow the link below. Learn more about this complimentary bootcamp and how you can watch it and what you can gain out of it. And send me an email, support@marketgeeks.com. I want to hear from you. Tomorrow, top ETF and top option picks. And again, if you want a good stock, CMA, and if you want a weak stock, IPGP. Follow the link below. Check out my bootcamp. I'll talk to you guys later and send me some emails. I want to hear from you. Bye.